eventually, if everybody's doing it, it's not going to work. So anyway, I do think there are limits to AI, and at least for the foreseeable future, I think a really good discretionary trader is going to trade better than the very best AI algorithms.
Welcome back, everyone. Welcome back to this interview with Al Brooks. Al is the person I've interviewed on the channel here that has the most views. So your interview was the most viewed on the podcast and the YouTube channel, which is really good. Good to talk to you again. Good to sit down with you once again. I think it's been a while. So what's been going on since we last spoke?
Well, as I said before you turn on the recording, the pandemic is the main thing. I've been just working. Although over the past few months, I'm starting to take vacations again, which is fun.
That's pretty good. So one thing I'm curious is, what have you been working on? What are some things that kind of fascinate you or make you want to work on?
Well, it's interesting to me. At this point in my life, I would have imagined that I would have been at a point where I feel like I know everything that I need to know. But every day, at the end of the day, I print out charts and I review things, and I feel like I'm still getting better and better and better, which is satisfying. Otherwise I would be bored. So I'm still having a lot of fun doing what I'm doing.
Always learning, for sure. So one thing I want to ask you, and we'll go into topics that are more kind of specific to how people can become better traders, but I'm curious to know first, what's your view on the market right now? What are some of the common themes you see in the markets, and anything that you specifically look at right now that you are paying attention to more than in other markets?
I tend to try to be fairly simple when I look at markets. And I sometimes make the analogy to Forrest Gump. And, I say that Forrest Gump probably would make more money than Albert Einstein, because I think you're better off not overthinking. And when you look at the market's in a bull trend. It's in a bull trend on the monthly chart, on the weekly chart, on the daily chart. And it's had many attempts to reverse. And it's kind of like trying to hold a beach ball underwater. You're not going to be successful. The market's going to keep going up. At some point, it's going to reverse. And there are some things going on now that I've been writing about over the past few months that increase the chances that we're going to get a reversal. For example, on the weekly chart, the market has been going up in a very tight bull channel with very small pullbacks. And I labeled that kind of a trend, I call it a small pullback bull trend. And the biggest pullback that we've had since the pandemic crash was about 10%, and that was a year ago in September. And a small pullback bull trend can last a long time. And there's one thing I look for to signify that the small pullback bull trend has ended, and that's a big pullback. And by a big pullback, I mean a pullback that is 50% bigger than the biggest pullback in the trend. And since the small pullback bull trend has had a 10% pullback, and since I expect one that is 50% bigger, I'm looking for a 15% pullback at a minimum. And we might be in it now. I think there's a 50% chance that the market is in a 15% pullback. It's going to be interesting to see what happens if the market gets up near the September high. Will it reverse down and form a double top, or will it break through? The market's been sideways now for 4 months, and I think even if we do go to a new high, I think we're not going to get much above the old high. We might get up to 4,600, 4,650, but I really think the market is going to have a hard time going much higher, because the small pullback bull trend has lasted a really long time. And normally the market does one thing for a while and then it does something else. A small pullback bull trend is a very strong trend. It's unlikely to go from a bull trend into a bear trend without first transitioning into a trading range. And therefore I expect a trading range, and I expect the bottom of the range to be at least 15% below the top. So over the next several months, I think there's a 50% chance that the September high will be the high, and that we will correct down 15%. And that means below 4,000 on the S&P.
What are some of the signs that the market's going into a sideways market? Is it just based on the highs, the lows, or do you have any other factors to consider, like volatility or other things that kind of showcase more a sideways market compared to a trend?
Well, first of all, as I said, we've been sideways now for 4 months. And at some point, either the bulls give up or the bears give up. So either we break to the upside or to the downside. I don't think we're going to go much higher because I think we have exhausted bulls. The small pullback bull trend has lasted such a long time. And I do think we have the potential to go a lot lower than what people think. That's why because everyone sees the market going up forever, they assume it'll keep going up, and it's not going to keep going up. And as I said, one way to estimate how far down it will go is to expect it to go 50% more than the biggest pullback that we've had since the trend began. And that's why 15% is what I'm looking at, and that's below 4,000. Also on the monthly chart, since the pandemic crash, there have been 3 times when we've had bear bars, and this is the 3rd time. And if you look back at the cash index or the E-mini for decades, if the market is in a climax phase, which it is now, and you get a bear bar, you normally get a second bear bar or even a 3rd bear bar starting within a month or 2. So even if October is a bull bar on the monthly chart, then probably November will be a bear bar. And that's consistent with what I'm saying about the weekly chart. So that's another reason to expect that the market will correct for more time. In other words, 2 or 3 months. And if it corrects for 2 or 3 months, it's reasonable to expect it to correct more than what it has corrected already. And that's why I go to the weekly chart. And that's how I come up with the 15% correction.
Interesting. Have you been following cryptocurrencies at all? Is this something that you look at or you pay attention to?
Yeah, I've bought cryptocurrencies, and yes, I pay attention to cryptocurrencies. I have 2 fundamental problems with cryptocurrencies. I have the Jamie Dimon problem. He's the CEO of JP Morgan, and he's generally considered to be the wisest banker in the world. And he says, he uses a lot of unkind words when he talks about cryptocurrencies. But my problem is the same one that he has and that Warren Buffett has. There's no compelling reason for cryptocurrencies to exist. However, I understand the idea of a store of value, and it's more practical to have a digital store of value than to have gold, which is physical. And who wants to have a bunch of gold in their house? It's easier to have a bunch of code on your computer, passwords on your computer to store your value, and to have it be independent of all governments in the world. I understand that appeal. What I suspect ultimately is going to happen is that the governments are going to be sufficiently bothered by the criminal element profiting from cryptocurrencies that the governments will ultimately come up with some kind of their own cryptocurrency. And I think the ideal situation would be to have the Western governments, the United States, Europe, maybe Africa, maybe South America, get together and create their own cryptocurrency, and one that can be overseen by governments. In other words, not so much crypto. So make it very difficult for the criminals to use it as a tool to maintain wealth and to make wealth. So that's one problem with cryptocurrency. That's the other problem with cryptocurrencies. I think ultimately governments are going to get involved. So, and the first problem is the one that there's really not a great reason for it to exist, and there's not great use for it, at least not now. So it's a trading vehicle. And I often, people sometimes ask me, Al, are you a gambler? And I say, I'm not any more a gambler than somebody buying a business, hoping it'll go up in value, somebody buying an apartment building, hoping it'll go up in value. So I don't view myself as a gambler. I view myself as an investor, but a very short-term investor. I invest sometimes for a minute, sometimes for 5 minutes, but I'm an investor. Cryptocurrencies is to me, it's much more gambling because there's no fundamental basis behind it. It's just betting. It's going up, I'm going to buy. If it goes down, I'll sell. I think that's more the attitude. It's not that lack of a fundamental basis makes me, I'm willing to buy it, and I sometimes do buy it. For example, Bitcoin on big sell-offs. But my concern, I'm much more worried about cryptocurrencies suddenly going bust than I am about Microsoft or Amazon suddenly going bust. And when cryptocurrencies go bust, if they go bust, I think it's going to be just over the matter of 2 or 3 days. It'll go from 60,000 to zero. And even if it didn't go to zero, if it went to 10,000, I wouldn't want to own something at 60,000 and then have it be worth 10,000 2 days later. So, if all of a sudden a group of major governments, the United States and the EU, announces that they're going to go into the crypto business and create a government supervised crypto business, I think, and they heavily regulate or they make it illegal to transact in the current cryptocurrencies. I think there's a risk that very quickly they'll go to zero. So it's kind of like musical chairs. As long as the music is playing, you can run around and have fun. But when the music stops, there's not going to be anybody to buy when you want to sell.
And this is a really good point, and a really good segue into something else I want to talk about for sure is the fact that a lot of people use price action to enter trades. Like they look at these setups to get in the market, but it seems like few people I talk to seem to be able to understand when to get out with price action. Like they cannot read the price action in order to get out the trade. So what would be advice for people, and what are some tips for them to be able to avoid losses with price action? Like being able to pick when price is near a top or starting to decline, changing phase. How should people do that?
Well, there are two ways that I do it. First is what you're saying, if it's near the top. Near the top of what? Near the top of a bull channel. Let's talk about the longs. If the market is near the top of a bull channel, and if it suddenly creates whatever time frame you're trading. So if I'm trading a 5-minute chart, which is what I usually do, and I see a bull channel, and all of a sudden there's an exceptionally big bull bar, and it reaches that top of the bull channel, I'm always going to be exiting at least half of my position, if not my entire position, depending on what else is going on. So one thing to do is exit during exceptional strength at resistance, especially if the top of the bull channel, if you look to the left on your chart and you see that it's also forming a double top, it's testing a prior high. So is it both testing the top of a channel and testing a prior high? That would make me much more likely to get out of the market. And then the other thing is if the market goes down, and how far down? Well, it depends on your time frame and your goals as a trader. If you're a very short-term trader, for example, if I'm trading the 5-minute chart and we have a bull bar and I buy the close of the bar or buy on a stop above the high of the bar, and we get a second bull bar and a third and a fourth and a fifth and a sixth consecutive bull bar, at that point, I'll have a pretty good profit. I will get out maybe the height of a bar below the prior bar. So let's say the bar is 5 points tall, and then the next bar is another bull bar, and then another bull bar. I'll get out with a stop about the height of a bar, 5 points below any bull bar. Also, if there's a bear bar closing below its midpoint, I'll get out one tick below the bear bar. And you can say, well, Al, it's stupid. If it's still forming higher lows and higher highs, it's still a bull trend. Why not put a stop below the most recent higher low? And I'll do that as well sometimes. But if I'm trading, I often will get out with a very tight stop, for example, below a bear bar closing near its low. And I'll do that because I feel confident if the bar after that is another bull bar closing near its high, I'll get back in. And most people can't do that. Most people, they get out and they say, boy, I need time to recover. And they don't get back in. But if you're able to get back in, then you can get out with tight stops and you can just get out and get in, get out and get in if the bull trend continues up.
And this is an issue that I see a lot of people struggle with also, is the fact that let's say they're long in any pair, any trade, then they have like this big bull bar, and they think price will go more like further than that. So they extend the trade, then they have the retracement, price goes down. Then they want to keep getting that. They want to keep getting to that high again to get out trade. So they hope for price to get back to the high that it was before, which is of course a big mistake for people when they trade.
Yeah, I want to say something about that. Let's say you buy a market that's going up, which is reasonable because if the market's going up, it's probably going to go up more and you'll be able to get out with a profit. But anytime you buy at the high, you should look at the most recent higher low because you probably will have to risk to below that higher low. So you'll have a lot of risk. And if you have a lot of risk, you have to trade small. And what a lot of professional traders do, and what I do, is if I'm buying high, I'm hoping the market goes up higher and I can exit with a profit. But I will use a very wide stop. And really importantly, I'm willing to add on. So I'm betting on two things if the market is strongly bullish. It's either going to go up and continue to be strongly bullish, or it'll transition into a trading range, not become a bear trend. Strong bull trends typically either continue or they convert into a trading range for a period of time before they become bear trends. And if it enters a trading ranges have legs that go up and go down. If I buy at the high and then it starts to convert into a trading range, it goes down. I buy more and I expect it to go back up to the top and start to look like a trading range. So if I buy, let's say I buy at 100 and then it falls to 90 and it starts to go up again, I buy more at 90. If it gets back to 100, now I'm thinking, oh, maybe it's a trading range and not a bull trend. And if it's a trading range, do I want to be long at the top of a trading range? So what I'll tend to do is I'll tend to exit. Remember, I bought at 100 and I bought at 90. When it gets back to near 100, I'll get out at 100, break even on my first buy, and with a profit on my lower buy. And that sounds simple, but the single biggest reason why traders lose money trying that strategy is they trade too big. When they buy their initial position at 100 and they see the stop has to be at 90, they're comfortable risking that amount. And they think in their head, I'm okay. I'll buy more if it gets down at 90. And what most beginners do is when it gets down at 90, they say, oh my God, I'm down 10%. I better get out. And that's the exact opposite of what they should be doing. They should be looking for an opportunity to buy again, to double the size of the position. So, but as I said, this sounds easy, but it's very difficult for beginners to do. Beginners are much better off getting out early and not holding through the transition into a trading range and then scaling in. But that is, I do that. I do that all the time, and it's a very good strategy. If you do it and you do it well, I think you have an 80% chance of not losing money. So if you buy at 100 and it falls to 90, two things can happen. Well, three things can happen. If you keep going down, I'm not going to buy more unless it looks like it's starting to turn back up. And if I buy as it's starting to turn back up, I'm expecting one of two things to happen. If the sell-off is not too strong and the reversal up is reasonably good, I'm going to hold for it to get back to 100, and then I'll get out of the entire position at 100 with a profit on the lower and break even on the higher. The second thing that happens is it'll go a little bit more than halfway up. That's one of the reasons why there are 50% corrections. People buy at the top, they buy a pullback, and when it gets 50%, they can exit break even on the trade. They lose $5 on the buy at 100, they make $5 on the buy at 90, and they get out at 95. And that's one of the reasons why 50% corrections are so common. The people who bought poorly and the people who bought well, if they scale in, that's their midpoint and they can get out without a loss. So 80% of the time, if you buy a strong trend and you buy more lower, you're going to be able to avoid a loss. That means 80% of the time, you're going to get a 50% bounce.
Interesting. And this is really key. So you just explained a big fact about the market. That percent retracement, I think, is really big. I didn't know why that was happening. So it's really good that you explained it. And that's a really good thing.
Yeah, I think nobody thinks about it, but I realized it decades ago because I was trading, and that's what I was doing. I said, wait a minute, that's why 50% corrections are happening, because people are doing what I'm doing.
How many times you tend to scale into a trade? Do you have like a limit of like, let's say 2, 3 times, or can you scale in as much as you can, or how do you decide how much to scale in?
For scaling into a trade, my basic rule is if I buy at 100 and I'm thinking that I'm willing to scale in, I'm typically looking to double the size of my position. So, so if I'm looking at and it falls to 90 and I buy again, I'm typically going to be doubling my position if I'm buying above a bull bar and the bull trend is resuming. On the other hand, let's say we have 5 bull bars in a row, and I buy at the high of the bar, and then it goes below a bull bar. I might buy more at the bottom of that bull bar. Okay, so let's use the E-mini as an example. The market's going up, and it's a buy the close type of rally. You got 4 or 5, 6 consecutive bull bars closing near their highs. If I buy at the market, I'm going to be willing to scale in because I expect the market is either going to go higher or enter a trading range. I might buy more with a limit order at the low of the bull bar, thinking that the first reversal down will be brief. But sometimes it won't be brief. Sometimes it'll just start going down, 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 down. And remember, once I put on my buy at the top, so if I buy at the high of the bar and then I buy more when the next bar goes below that bar, so now I have 2 contracts, right? So that's my market order, limit order entry. And if it starts to sell off, I'm looking for a stop order entry. I'm looking for the market to eventually form another bull bar closing near its high. It might be 5 or 10 bars later. It might be a lot lower. But for that stop order entry, I want to double my position. So if I bought 2 at the high, and now I'm looking for my stop order entry on the pullback, hoping for the bull trend to resume, I'm going to buy 2 more. So I have 4 contracts. And I know where my stop will be. It'll be below the most recent major lower, higher low. And so I know how much risk I have. And when I put on that original position at 100, I'm aware that I might buy more below the bar, and then I might have to double my position to get 4 E-mini contracts. And then I know where the stop would have to be. So I kind of do the math in my head. I don't want to risk more on any trade, including a scale-in trade, than I would on any other trade. So you have to be trading really small. And, as a general rule, most traders should not risk any more than 1 or 2% of their account on any one trade. So if I buy 1 at 100 and I'm thinking I might have to buy a total of 4 and my stop has to be at 80, I have to do the math so that does not add up to more than 1 or 2% of my entire trading account value. At this point in my life, I have a whole bunch of accounts with a whole bunch of brokers, and that's because once you've been doing it a long time, you don't want to get messed up by some broker. And I remember years ago, I don't know, maybe 30 years ago, I had several accounts, and one of the brokers said, "Al, you can't open an IRA account unless you put the money with a trustee. You can't directly own an IRA account. We can't have the money. We have to have a trustee hold the money." And I don't remember which broker it was that said this. I think that was kind of the rule back then, about 30 years ago. And so I had the account. At some point later, 6 months, a year later, I got a message saying that the money was gone. So here, the broker told me I had to have the money in with this trust company, and they recommended the trust company. And the guy who ran the trust company ran off with everybody's money, and they never found the guy again. So I don't know, it was like $100 million total of all the accounts that he stole. So that's another example of when you think you're in a really secure situation, your broker is telling you you have to put your money in this trust company so that you don't have to worry about us stealing your money. They don't tell you that the trust company might steal your money. And, so stuff happens. And, Shearson Lehman brokers, they went bankrupt. and there are limits on how much the government will cover on any one account. So I try to keep my accounts below the limits, and I want many different accounts so that if any one account, any one company goes bankrupt, I want to have, I don't want to lose everything. I don't want to lose too much. No, I lost my thought. Where were we? Take me back to where we were.
It's also a really good point of the fact that you should have multiple brokers account for sure. Sometimes the platform might bug, you might have trouble with it, or like the capital thing also. So multiple accounts is definitely the way to go for sure.
I want to say one thing about that risk. I said traders should never risk more than 1% to 2% of their account. And if you're starting out, let's say you have a $5,000 account, sometimes it's hard. Sometimes you might have to risk 3%, but rarely you should do that. You should only risk 1% or 2%. And now that there are micro E-mini contracts in the United States, which is 1/10 the value of an E-mini, you can trade that. Also with Forex markets, you can just trade 5,000 units, 10,000 units instead of 100,000 units or 1,000,000 units. So you can trade very small. And I sometimes hear people tell me, Al, if I trade one micro E-mini contract or 10,000 Forex units, I'm never going to get rich. And my answer to that is, when you're starting out, your goal is not to get rich. Your goal is to stop losing money. And you want to be losing as little money as possible. So the first objective is to stop losing money. The second objective is to grow your account. And that might take a year or 2 or 3. But at some point, if you're doing the right thing, you will be making money. And you'll grow your account to the point that you can start to trade 100,000 Forex units, or you can start to trade a single full size E-mini contract. And if you do that for a few years, all of a sudden you can start trading, doubling it or tripling it. And at that point, you can start thinking about making a lot of money as a trader. So yeah, everybody wants to get rich, but there are steps involved. And when you start out, you don't want to be losing much money. And the best way to do it is to trade very small. And then your first goal is to stop losing money. Your second goal is to become consistently profitable, and grow your account. And then you start thinking about making significant money.
I know the last time we interviewed, we discussed the topic of algos and high frequency trading and things, and whether that would change price action or not in the future. What I'm curious now is about AI, so artificial intelligence. Do you think that will affect how the market moves and price action overall, or is it something that will just make the market the same as it's now, basically?
Well, that depends on, again, time frame. Artificial intelligence is intelligence. You're intelligent, I'm intelligent, most traders are intelligent. We're all intelligent. And if you put hundreds of thousands of intelligent people together, even without AI, you're going to get a manifestation of their behavior. So what happens in the market is simply a representation of rational human behavior. And artificial intelligence can come to rational decisions faster than you and I can. It can place trades in and out faster than you and I can. But it's still basically going to be rational human behavior. It's not like there's an entirely different world of logic out there. Logic is logic. You buy because you think it's going to go up. You sell because you think it goes down. And it's not like artificial intelligence is some super force. It's not. It's just speed. It just comes to the same conclusions that a group of traders would come to, and it comes to it faster. So I said, if you look at a monthly chart, the monthly charts today, even though probably, 70, 80, 90% of all trading is done automatically, which means artificial intelligence, the charts are the same. They're indistinguishable from 100 years ago. And therefore, artificial intelligence is not changing things on the higher time frames. And it makes sense it really would not, because the big advantage of artificial intelligence is speed. And on a monthly chart, who cares if a computer can do things in a fraction of a second? It's a monthly chart. I have a week to make up my mind, right? But if you look at a tick chart where you see every trade taking place, every now and then you'll see in the E-mini, you'll see the market jump 3 or 4 points in 1 or 2 seconds on a lot of volume, like 5 or 6,000 contracts. And that's some computer or 2 or 3 computers trading 1 or 2,000 contracts and looking for a quick move, a 1 or 2 point move of profit. And as an individual trader, I can't compete with that. Also, a lot of the trades that you see, most of the trades that you see, there's a lag between the time the trade took place and it appears on your computer. And for example, on a report, FOMC report, you'll see the market makes a very big move, very quick move. But before the market even moves 1 tick, there are a whole bunch of computers in New York right next to the exchanges that have already bought and sold 2 or 3 times before you see the market move at all. And there's no way you can't compete with that. And even if you got the data as soon as they got the data, you still couldn't make the transactions as fast. They are trading in terms of milliseconds, nanoseconds, and they pay a lot of money to be right next to where the internet is in New York City. So there are certain buildings that are right next to that internet, where the internet pops up in New York City. And those buildings cost more to rent than a building a block or 2 away, because the people who are in those buildings, their computers get the information a nanosecond or a few milliseconds faster than the computers a block or 2 away. So they can be in and out before the guy 2 blocks away can be in and out, and they have to pay more rent to get those extra fractions of a second. So artificial intelligence, it's important if you're trading at those time frames, but we're not. On a 5-minute chart, I have seconds, several seconds usually to make up my mind, sometimes many minutes to make up my mind. And artificial intelligence, speed is their advantage, and there's no great advantage on a 5-minute chart. So as far as you and I are concerned, it doesn't affect us.
Wouldn't the fact that you take emotions out of it, that AI will take kind of different trades, that it wouldn't take the same trades as human would do, because humans have into account emotions. They act based on impulse and how they react to things.
Right, that's true. So the computers are very good at being objective. Sometimes you'll look at a chart and you'll say, if I'm willing to risk a whole bunch of money and go for a very small reward, I could win a very high probability of the time. Or the opposite. If I'm willing to risk very little money and go for a very big reward, I'll lose most of the time, but sometimes I'll make a lot of money. And both of those things are emotional, and computers can do those, and you and I cannot. So let's say the market is falling right down to a really obvious prior higher low. A computer might buy 1 tick above that higher low and exit 1 tick below, risking a total of 2 ticks, and hold on, hoping to make 100 ticks or 1,000 ticks. So what are the chances of you risking 2 ticks and making 100 ticks? It's really small, right? But if the math makes sense, the computers will take that trade. You and I would never take that trade, but a computer might take that trade. So computers can take trades that have either very bad probability or very bad risk reward, at the extremes that you and I would never take, and they can handle it objectively. But you and I, if we took a really low probability trade, we would need tremendous reward to offset the low probability. Or if we were to take a trade with tremendous risk reward, very little risk, we would need incredibly high probability to offset the bad risk reward. So at those extremes, the computers can do well and not deal with the emotion. Also, a lot of times, the trade will have to take a lot of time, and that causes a lot of pain to an individual trader. So at the extremes of probability or risk reward, the computers can do things that we cannot do. But everything else in the middle, we can do fine. And I think a really good discretionary trader is going to do better than artificial intelligence. And why is that? Because a really good experienced trader, or someone who's really good at reading charts, can analyze far more data than a computer program. A computer program is only going to look at a certain number of variables. They can't program in 300 variables, right? It's just not going to happen. And every variable, there are sub variables, whereas a really good discretionary trader can process things. They can select the important variables pretty quickly and weigh them out. Artificial intelligence is nowhere near able to do that. Also, if you think about it, let's say some artificial intelligence algorithm could analyze all the variables that I can as an individual trader and weigh them properly and come up with instantaneous decision making. Well, if one company can do it, can another company do it? Of course, eventually all the companies could do it, right? So if all the companies are going to be doing the same thing, who's doing the opposite? If you want to buy, somebody's got to sell, right? And if all the companies are buying and there's nobody to sell, they can't buy. So geese can't lay golden eggs. Eventually, if everybody's doing it, it's not going to work. So anyway, I do think there are limits to AI, and at least for the foreseeable future, I think a really good discretionary trader is going to trade better than the very best AI algorithms.
Definitely fascinating to see how this will unfold and happen. I'm really curious to see that for sure.
Yeah.
What would be your advice for people who want to be able to get familiar with these patterns in the market, either like price action patterns or patterns that repeat themselves in the market? How can people get more familiar with them and kind of learn to execute them better?
Well, if you're a professional soccer player, you play a match every 2 or 3 weeks. What are you doing in the meantime? You're practicing. If you're a concert pianist, you might perform, every week or two, or you may perform every night for a week, but then not for 2 or 3 weeks. You're practicing. And as a trader, every day and for all my life, I look at the charts and I go through the charts at the end of every day, and I go through every bar. For example, in the E-mini, on the 5-minute chart, there are 81 bars in the day, and I look at every bar, and I post charts. I mark them up every day, where I think reasonable buys are, reasonable sells are, and I draw lines showing what the major patterns are. And I do it every day. And as long as I'm going to trade, which I hope is forever, I'm going to do that every day. And that's practice, because sometimes the market will create some kind of a pattern, like consecutive outside bars. It might do it for 2 or 3 days and then not again for 2 or 3 weeks. And 2 or 3 weeks from now, I want to be able to quickly pull it out of my head when I see it happening. It's not like the market does the same cluster of things every day. There's a big basket. I have an encyclopedia that I make available to people on my website. It has about 400 patterns in it, or variations of patterns, and I'm very familiar with all of them. And because I look every day for every one of those patterns, and every one that I see, I mark up on the chart, and then I post it. And I think it's really important to every day, rehearse, practice. At the end of the day, look at the chart, look at every trade you took, look at every trade you did not take, think about ways that you should manage trades. So it's practice, practice, practice. And I think, that's forever. And I think that's the single best way to get good. And the more you practice, the better you'll be. So I think it's really, really important.
I heard some traders in the past who, like, let's say in their 20s, 30s, they scalp really intensively. And then over the years, they kind of start to slow down, go on higher time frames, start to swing trade instead of scalping. Do you think it's too stressful? It's hard to do for them when they get a bit older. How have you been able to keep up with that and to still like scalp right now and still achieve pretty big things in the market?
Well, when I was your age, I did trade at the extreme. I would trade 1-minute charts. Back then, they didn't have 15-second charts and 30-second charts. And 30 years ago, if they did, I probably would have traded 15-second charts. And there's one point I regularly make in the chat room, and that is when you're a trader, there are 2 objectives. There's one obvious one: make money. And we're all doing this to make money. But there's one really important other objective, and that's to have fun. And you need both if you're going to be doing this for a career. You can't be doing it for 20, 30, 40 years if you're not making money, and you won't do it for 30, 40 years if you're not having fun. You have to really enjoy what you're doing. And there are many ways to trade. I could trade a 5-second chart, and I bet I could do very well trading a 5-second chart where every bar is 5 seconds. But I'd be miserable doing it. And also, I would not be able to do it all day long. After 30 minutes or an hour or so, I would be bored. And it's just too relentless and too fast. And, it's too stressful. And that's true for 1-minute charts as well. I sometimes, if I'm not in the chat room, on days when I'm not in the chat room, if I have a lot of energy and I'm looking for some variety, I'll trade a 2-minute chart and I'll scalp all day long. But it's exhaustive. It's exhausting, and once you're exhausted, it's not fun. And even when I'm scalping 2-minute charts, I don't do it all day long. I'll do it for an hour or two just for fun. Just it's fun to say, yeah, I can still do it, all right. But I don't want to do it all day long. A 5-minute chart, I'm very comfortable doing. I look at 60-minute charts and hourly and daily charts and weekly charts and monthly charts. But you get, as a day trader, you have so few trades on the higher time frames that I don't pay a lot of attention to them. So for me, a 5-minute chart is that's my comfort zone. And there are 81 bars during the day in the E-mini. And on the 5-minute chart, I see probably at least 40 or 50 reasonable trades. I don't take 40 or 50 trades. I might take 10, some days 15 or 20, but I see 40 or 50 trades. And, I just take as many as I can. And I don't worry about taking every trade. A lot of times I'll miss great trends. Why? Because who knows? I'm tired. I'm distracted. I got stuff coming. I got contractors in the house. Who knows? I never worry about missing every trade. All I worry about is the trade in front of me. Am I taking a reasonable trade? Do I have it structured well in my mind? Why am I buying? What size am I buying? Where am I getting out? What will make me get out? If the market changes, what kinds of things will happen that will make me want to get out? Well, I want to add to my position. So I'm really all I'm concerned about is the trades that I take and managing them well. And I'm never hard on myself if I miss a trade. I'm not even hard on myself if I do something stupid. I'm pretty quick to get out if I do something stupid, but I have to be my biggest advocate. There's no one else out there rooting for Al Brooks, so I got to be my biggest supporter, and I'll let somebody else find all the problems with Al Brooks. I'm emotionally, you got to be positive, and you can't dwell on the mistakes, and you just have to keep looking for the good and looking for ways to get better. And you can't let mistakes get big. You got to get out quickly. If you take a trade because you had a reason to take the trade, and now the reason doesn't appear to be valid, you get out and then look for the next trade. And if you lost money, don't worry about it. You'll make it back if you consistently trade well for the next few trades.
This is a lot of good wisdom. This is really awesome. It's really good. There's kind of like these two thoughts of traders who say that you gotta, of course, study the market and learn about the market. Some people are gonna go and talk to other traders about it. They're gonna ask their friend who trade what they think of the market. Some people will study the market on their own. What do you think works the best for you? Is it like talking to other traders, how they do things, or is it really sitting down and going back and seeing the market yourself that makes you learn better?
It's really interesting. The point you bring up, it's actually a fairly big point. Put a lot of pundits on television, and the pundit will confidently say, "Oh, the market's going up," and you think, "Oh, Professor so and so, or the whatever, the chief trader at such and such a bank says the market's going up. I got to buy." Right? He doesn't say the time frame. He doesn't say where his stop will be, and he doesn't say what changes the market would have to do to make him get out. And he also doesn't say if he's buying, that means another institution is selling. So you're seeing one half of the argument. There's another institution who would say the opposite. There has to be, because if one guy's buying, he has to buy from somebody. That means somebody else has to sell. And I think it's kind of the religion thing. Everybody's looking for a protector, a god, a trading god. Let me have I want to see a trading god on television take care of me, protect me, so I won't die as a trader. My account won't die. My dream won't die. And I think that's natural when traders start out. That they're looking for someone to protect them, a father figure, a mother figure, whatever. So they're much more inclined to listen to what other people say. And for me, I don't care what anybody says. I've been doing this for longer than anybody you see on television. I have looked at more charts than probably just about anybody on the planet, and certainly more than the clowns that they put on television. And I am very confident about how I read the market. And I don't care if the guy on television says it's going up if I think it's going down. I don't care, right? It's an eat what you kill business. No one's going to take care of you. That guy on television is not going to tell you how to manage your trade. He's on television today, and what are you going to do tomorrow when the market is not doing what he said? You have to get good at things yourself. You have to develop experience. You have to begin to trust your decision making, and that takes time, and it takes practice. And that goes back to what I was saying. You have to learn how to read charts if you're a trader. If you're an investor, it's an entirely different thing. If you're looking at a 10 or 20 or 30 year horizon, just go ahead, buy Microsoft, buy Amazon, buy Google, buy, Lyft, buy Uber, buy, Tesla, buy any of it, right? And don't look at it. Just hold it for 10 or 20 years because you'll make a lot of money 10 or 20 years from now. But if you're sitting in front of your computer all day, you're a trader. And if you're a trader, you're not going to be trading based upon fundamentals. You're going to be trading based upon charts. And you have to be able to read charts.
Wow, this is good advice, and definitely your passion is contagious regarding the market. I think people are getting a lot from this interview for sure. I got a lot of it myself, things that I didn't even know about before. So it's really, really cool. Where can people find you now? Connect with you or reach out after the podcast? I know you have a course that's really good. We have people who watch channel who took your course before. They really love the content there. They love that it's really systematic and things. Where can they find this out?
Yeah, well, they can just do a search of Al Brooks or Al Brooks Trading. And my website is brookstradingcourse.com. So Brooks Trading Course, one word.com.
Awesome. Let's just put a link below anyway in the show notes for people to click on them if they want. And that's really good. I really love your work. I love what you do, Al. It's really good to talk to you always. And I definitely look forward to do this again in the future.